All right, today we're going to talk about three main contingencies that you'll see during the process of a real estate transaction. They are the inspection contingency, the appraisal contingency, and the loan contingency. And as a little extra bonus, we're going to talk about home contingencies for the sale of another property. First, we're going to share about inspections and disclosures. This is kind of like being on an airplane and having a pre-flight check done. What's going to occur is when you get into escrow for the sale of a home, the buyers will receive the disclosures and be given a set amount of time determined by your contract for how long they have to review those disclosures. They will also have a set amount of time for completing all inspections and then removing the contingencies attached to disclosures and inspections from there. Some of the inspections you might see is a general inspection, which is where an inspector comes in and checks all sorts of things all over the house. Sometimes buyers may choose to have other inspections beyond a general inspection. A lot of times common ones are a roof inspection or a main line inspection, which is the sewer line that goes out of the home. They may choose to have other inspections. There are tons of inspections they could choose to have. Everything from electrical to plumbing to the foundation could be inspected by a specific professional. As long as these inspections are handled within the time frame that you have agreed upon in your contract, the buyers are permitted to do so. Okay, so the buyers have completed their inspections. They have received their disclosures and signed off in writing actively for that inspection. That would be the next step for the inspection and disclosure contingency. The next type of contingency we're going to talk about is the appraisal contingency. This is like ensuring that you're going to have a safe landing from your flight. So you've done your pre-check, the inspections and disclosures have been signed, and now you want to ensure that your landing is going to be safe and on time. What do I mean by that? What the property value is determined to be based on comparable sales in the area and the condition of the home, and what the sales price is. Don't forget to like, comment, and subscribe, and hit that bell button. Okay, back to what we were talking about. The appraisal always needs to come in at or above the sales price. This is because if your buyer is choosing to get a loan, their loan needs to be approved at the sales price that they have agreed upon with you. If the sales price is higher than the appraised value, this could be a problem for both you and the buyers, but it could end up being that you have to renegotiate the sales price, or the buyers would have to bring in the additional cost from their own funds because the lender is not going to provide beyond that appraised value. The final option would be the transaction falls apart, and because this appraisal has come in low, it could affect the sales price that you have moving forward. Again, an appraisal contingency would require an active signature, and then the buyers have signed off and you can move forward to the next step. The third contingency is the loan contingency. This is where the buyers are basically navigating a storm during your flight. The loan contingency is important because the lender needs to sign off on many different pieces of the home. We have a property right now that's in an unusual situation because we were actually in process of selling this property, and the lender ended up pulling back their loan approval pretty close to the end of our transaction. This was because this particular home is in an HOA community, and the HOA community had recently decreased their insurance coverage for the entire complex. Because of this, the lender knew that there was going to be issues if potentially there was a catastrophic event that affected the entire HOA, and they wouldn't have been made whole for providing this money to the buyers. So the lenders pulled back and said, "I'm sorry, we cannot provide you with a loan for this home." In that case, the transaction ended up falling apart because the buyers were unable to secure a loan that was warrantable by a lender. This transaction actually fell apart at the very end. We were in the last week and a half of the process, and they had already removed their contingencies for appraisal, inspections, and everything else, and they were so excited to buy this home, but unfortunately, because of the situation with the insurance, the lenders were not able to fund. This is an unusual circumstance, but we're seeing more of it because of insurance coverage issues here in California. Many times insurance causes delays in the closing of our sales, and we've actually started including verbiage asking for the buyers to obtain insurance within a set amount of time of the transaction so that we can ensure that the insurance coverage is not what's delaying us or causing the transaction to fall apart. The bonus section I'd like to talk about is contingencies that involve the sale of an additional home. Potentially, you could get yourself into a situation where you have a buyer who is purchasing the home contingent upon the sale of their current home. This type of metaphor would be like a coordinating flight. One flight has to land before the other flight can be boarded and you could take off. So, in this particular situation, you may have a home that a buyer needs to sell, and once they are through the sales process, the contingency would be removed because then they can go through the purchase of the next home. Contingencies are a vital part of the sales process of a probate or trust property. You will find that these contingencies, the inspection, appraisal, and loan, are all common contingencies that you will see in the sale of a traditional home and in a traditional sale with a probate or trust home. Keep in mind that you may find that with property that's being sold to an investor, you might have really short timelines for these inspections. It may be that when they send over their offer, they actually send over a contingency removal for one or some of these contingencies. This is because they don't need to do additional loans and appraisals because they may be buying cash. I hope you found this of value. Please like, comment, and subscribe. Again, I'm Ashley Rivera with Probate and Trust Help, and we're here to lead, guide, and protect you through the probate and trust sales process. See you next week.